So you've got this guy, Seth Klarman. To some, he's one of the most brilliant investors on the planet, a billionaire who has quietly crushed the market for decades. But to others, he's a vulture, a guy who profits from a nation's misery. How on earth can one person be both? Well, let's get into it.
And that really is the question at the heart of it all, isn't it? How can an investor who is famous for avoiding risk, also be accused of being completely ruthless? This is the paradox of Seth Klarman, and it's what we're going to unpack today.
Okay, so before we dive into the controversy, you first have to understand the legend. In the investing world, Klarman is an absolute icon, but he does it all from the shadows. And that is completely by design.
Inside the world of finance, the guy is practically royalty. We're talking Warren Buffett is a fan of his work. People call him the spiritual heir to the father of value investing. But to the public, he's a total ghost. You're not going to see him on TV, he rarely does interviews, he just lets the numbers do the talking.
And oh man, do those numbers talk. Get this, for over 2.5 decades, his hedge fund, the Baupost Group, delivered an average annual return of around 20%. He took a fund that started with just $27 million and turned it into a multi-billion-dollar giant. That's how you become a living legend. So you've got to be asking, what's the secret sauce? How did he pull this off year after year? Well, the answer is this deceptively simple idea, and it's the absolute foundation of his entire worldview: the margin of safety. Now, he didn't invent this. He got it straight from his hero, the great Benjamin Graham. But the idea is just so simple and powerful. If you figure out a company's stock is really worth $1, you just don't pay $1 for it. Nope, you wait until you can buy it for 50 or 60 cents. That massive gap between the price and the value, that's your margin of safety. It's your cushion, your buffer against being wrong or just plain old bad luck.
You see, most investors, they're always thinking about how much money they can make, the upside, right? Klarman is the exact opposite. He is completely obsessed with how much he can lose. His number one rule isn't about hitting home runs. It's just, don't strike out. Job one is don't lose the money. He has this great little story he tells to make this point. See, back in the day, the sardines disappeared from Monterey, and the price of canned sardines just went through the roof. People were trading them back and forth like crazy. Well, one day, a guy actually opens a can to eat them, and he gets violently ill. He tells his friend, who just says, "You fool, you don't understand. Those aren't eating sardines, they're trading sardines." Klarman's whole point is he only invests in the eating sardines, the real businesses with real value. And this is where his philosophy gets really interesting. This whole focus on risk and value, it makes him uniquely built for chaos. When markets are panicking and everyone is selling, Klarman finally sees his moment. And you can see this pattern play out over and over again. Late 90s dot-com bubble, he thought it was nuts and just sat on his cash. 2008, the world is ending, he jumped in, buying up the debt of bankrupt companies for pennies on the dollar. Then again in 2020, with the COVID crash, he put over $1.5 billion to work. While everyone else is panicking, he's finally shopping. And just to remind you how bad 2008 really was for most people, the S&P 500 got absolutely obliterated. It lost almost 40% of its value in 1 year. Now, look at Baupost. While the market was in a complete free fall, Klarman's fund was down only about 10%. That's not a typo. That is the margin of safety in the real world. He kept his clients' money safe, ready to pounce. But, and this is a huge but, it's this exact strategy of buying things when they're in trouble that leads us to the much, much darker side of the story.
Okay, so let's fast forward to 2017. The island of Puerto Rico is in the middle of a catastrophic debt crisis. Things were already bad, and then Hurricane Maria hit, and it was just devastating. For Klarman, this was another crisis and another massive opportunity. So Baupost swoops in and becomes one of the largest holders of Puerto Rico's debt. They bought up bonds that gave them a claim to nearly $1 billion, and you can bet they bought them for a tiny fraction of that price. His fund now had a legal right to be paid back by an island on its knees. And this is where the criticism just explodes. As publications like The Intercept reported, the game plan seemed pretty straightforward. Buy the debt when it's cheap, fight to get paid back in full, and potentially make a fortune. Critics immediately started calling this vulture fund behavior, profiting directly from the island's pain. Because here's the thing, to pay back bondholders like Baupost, Puerto Rico was forced into these crippling austerity measures. We're talking massive tax hikes, cutting pensions for retirees,
shutting down hundreds of public schools. The human cost was just immense.
And the backlash was fierce. A lot of big university endowments invest their money with funds like Baupost. So you had students at Harvard, Yale, and Cornell organizing protests, demanding their schools pull their money out of Klarman's fund. All of a sudden, the silent billionaire was facing some very loud, very public anger.
So this brings us full circle, right back to that paradox we started with. How do we square these two images? The brilliant, cautious investor on one side and the ruthless opportunist on the other.
On the one hand, if you look at his philosophy, it's just intellectually sound. Buy undervalued assets, avoid loss. He bought legally issued bonds for less than he thought they were worth. He followed his own rules perfectly. But on the other hand, the critique is that when you apply those same rules to a humanitarian crisis, they stop being smart and start being extractive, and maybe even immoral.
In the end, Seth Klarman's strategy worked. He protected his investors' capital and almost certainly made a profit, just like his philosophy says he should. But his story leaves us with this huge, really uncomfortable question for the entire world of finance. In the relentless search for value, where does a financial calculation end and a moral one begin? That's the line Seth Klarman forces us all to consider.